Welcome to Stocks in Translation. I'm your host, Jared Blikre, along with the voice of the people, Sydnee Fried. And today we finally have Steve Sosnick. He is a chief strategist over at Interactive Brokers. He's also an expert on the options market. We're going to be talking about that and a lot of volatility talk. And our phrase of the day kind of relates to that. It's 0 days till options expiration, or just 0 days till expiration, 0 DTE. It's a phrase from the options market and a way of life for a number of people. We're going to break it down. And we also want to mention that this episode is brought to you by the number 2000. That is the number of stocks in the Russell 2000. And that's how many small cap companies comprise this barometer of risk. And it's not just a number, it's not just an index, it is a benchmark for opportunity. And we're going to explore that. So Steve, this is a relatively quiet week, and I think investors are kind of welcoming that because we had so much turmoil at the beginning of the month. We started out the worst month in over a decade, and now we're in the green.
Yes, but I mean, as we finish, we're taping this on Wednesday just before NVIDIA earnings, so that could be a very obsolete comment, later this afternoon.
Noted.
The one thing I look at is, we've kind of gotten used to some calm, but over the coming weeks, there's a lot of events that can really disrupt the calm. Mentioned NVIDIA. Mm-hmm. We also get the PCE deflator, the Fed's preferred measure of inflation. Next Friday, a week from Friday, I guess sort of the first Friday of fall, we get the jobs numbers. And considering that Powell told us, at Jackson Hole that the dual mandate is in effect, we're not just worried about prices anymore. We're worried about the full employment portion of the mandate.
The downside to labor. Yeah.
Exactly. So, was last month's reading a bit of a negative aberration, or was it the start of a new trend? We'll get some clearer picture on that, which is very important. We also get PPI and CPI, and then on the 18th, I believe, we get another FOMC meeting. So
that's a lot.
There's a lot coming down the pipe. So just, I think we can enjoy the peace and quiet while we have it.
It sounds like there could be theoretically a lot of risks that you're describing to the market. So should people be kind of hedging their portfolio right now? Should they be thinking ahead to these risks?
The VIX is relatively low.
Boom. That was it. The VIX is relatively low. And remember here, VIX, one of my common, go-to phrases is VIX is not a fear gauge. It plays one on TV. It is specific. It is kind of, it does reflect the level of fear in the marketplace. But I think first of all, it's really designed to show us the market's best estimate of volatility over the coming 30-day period. That's really, I don't want to get too deep in how it's constructed, but that's what it is. There's no component of fear. Realistically, where it comes into play is I think VIX is the best proxy for the demand for hedging protection from institutions, because it is really the simplest way to do a short, quick hedge on a portfolio. And so what it's telling us is the market doesn't expect a lot of volatility over the coming 30 days.
Let's get to our word of the day. It's actually a phrase of the day. 0 days till expiration, 0 DTE. You can see it right there. Options expire the same day they are traded. That's what these do. They are popular for their potential to generate quick returns, but also carry the risk of significant losses due to the rapid time decay and price swings. So, Steve, let's back up and explain the structure of the options market. These are same-day options, but the expiration comes on 3 days a week, and there's a whole history there. We used to have monthly options, 1 day per month, and then it was weekly, and now we have Monday, Wednesday, Friday, as I understand. Tell us how this works.
An option conveys the right, but not the obligation, to buy or sell, whether it's a call or a put, a specific, we'll call it a stock, it can be other things, but a specific stock at a given price on or before a given time, if it's an American option, which is what we trade in the US. So that's really what it is, and that's sort of a long-winded explanation, but the key elements there's the time to expiration is always the key element, and the price, and the strike price, of course, is a key element. And so what happened was I actually stumped a panel, an options panel. This was a room full of options professionals.
I like how this is setting up.
And I said, when was the first zero-dated option? And everybody sort of threw out numbers, 2022, 2019. And I said 1973.
Was that the very first day options were introduced?
The options were introduced, listed options were introduced by the CBOE in
So that on 1 day per month you could have 0 days.
Bingo, exactly. So options always were 0 days to expiration on expiration, on the expiration. And as a veteran reporter, you've reported on plenty of triple witching days and monthly expirations and all that, and that was very much
I love the quads back in the day. Don't have those anymore, but
yeah, we got rid of the single stock futures.
No volume.
There was no volume. We actually. Interactive Brokers owned a piece of the One Chicago Exchange, and so we were the last market makers in single stock futures, and it just there was no
pandemic clears the way.
Yeah, zero interest rates also clear them out because there's a margin advantage, which we're getting a little off stream, but there was really no value added when rates were sort of zero, so they never got adopted.
Can you clarify something for me? So with 0 days to expiration, does that mean if I will use X stock, a random, not US Steel, Apple, any stock, if I buy a call today and it's for $10, I can buy the stock for $10. You're saying a 0 day to expiration means that it expires at the close of trade that very same day?
Yes. So that's one of the keys. An option is the longer the time you have to expiration, the more value that option has, right? Because you have many more chances for the stock to close in the money, above the strike price if it's a call or below if it's a put. If you have 30 days to expiration, as opposed to if you got to have it happen by 4 o'clock this afternoon. And so that actually, you led me into one of the points that I try to make about zero-dated options, and that is they're simultaneously the least expensive and the most expensive options you can buy.
Good dialectic there.
Yeah.
I like that. So how does that relate to the concept of time decay? Because that's instrumental. We're talking, if you're buying it the same day, time is working against you because there's so little, but it's also maybe working for you. Just kind of break that down, maybe.
That's exactly what it is. So they're the lowest, all things being equal, they're the lowest they're the lowest priced options on the board because they have the least time value. Mm-hmm. But what also happens is they're pure decay, basically. Any amount that's above the intrinsic value, and intrinsic means, if the stock is trading at $82 and you have an 80 strike option, the intrinsic value is $2. So anything above that $2 is pure decay. There's very few things that are sure things in the options business. The only one that I can come up with is that your extrinsic value, the money you pay over and above intrinsic value, will be gone by the end of the day. It'll be gone at expiration because it vanishes. So you're paying the least amount of time premium, but you're fighting the knowledge that any excess value in that option will be gone by the end of the day.
Is it popular to do this kind of trading on a day like today, for example, for NVIDIA?
And what is it the last tick of the day? Is it the close of the day? Mm-hmm. That's an important distinction. I hear all kinds of assignment nightmares.
Let me unpack a bunch of things.
Yes.
So currently, the only items that have zero-dated options, daily expirations, let me be very specific, daily expirations are major indices, SPX, NDX, and the ETFs that are based upon them, spiders, Qs, et cetera. And a whole bunch of others, but it's basically there are no individual stocks that currently expire on a daily basis. They are weekly options. So the nearest term option that you could buy for NVIDIA, as we're taping this on Wednesday, expires Friday afternoon. So again one of the things you see is you're actually paying a good premium, and from volatility point of view, for that option, because whatever's going to happen is going to happen quickly. And NVIDIA four of the last 6 earnings, it moved over 9%. So the volatility is very high. It's 11% right now. When I last checked on those options on a daily basis.
You're very good at explaining such a complicated topic.
Here's another one.
No, but it is a complicated topic. So if you want to get into options trading of any kind, what is something you should know as a beginner?
The things that you should know as a beginner are that don't be seduced by the profit potential. And I think that's where a lot of people.
Good for trading in general.
It's good, yes. That's something you should, I think it's very important in general. Great point, Jared, is you should always be cognizant of what you can lose, let alone what you can win. If you're an options buyer, the good thing is your maximum loss when you enter the trade. You buy this option, and it either expires in the money or out of the money, and you win or you lose. The problem with that is, most options expire worthless. I forget what the current number is, but call it 70% is probably about right. Maybe 70, sometimes 80. But so that means that it's skewed toward the seller. The sellers win most of the time. That's just the way the options market works. Because quite frankly, as a former market maker, I know how they
pick up dimes for years, but they also get run over.
You get run over, so you have to build in the times where you're going to get run over. A lot of people, and I don't love going too deep into this analogy, but a lot of people got into options trading when sports betting was off
true.
In 2020. That we've legalized as a nation, we legalized sports betting. Then the COVID pandemic wiped out sports for a while. So people said, "Oh, what can I do?" Well, in many ways, an option is similar to that because you lay out a certain amount of money, and you have the potential for a leveraged return. In the case of a sports bet, it's defined. It's 2-to-1, it's 4-to-1, et cetera. Options, it's undefined. So I don't want to overstate the similarities, but I think that mentality is the same. On the other hand, most gamblers are not successful over time either. The house
side.
tends to win. The bookies charge a vig, whatever. And I'll say as an option maker, that was we wanted to build in a little bit of profit potential for the reasons you said, and so that's one of the things you should know is it's a great way to lose money slowly.
And quickly in a few cases.
And quickly in a few cases. Well, yeah, but that is really that's really what you're fighting against. Many of the more sophisticated players who use zero-dated options tend to be writers. They tend to sell them based for the reasons we said, because you write this option, you collect your decay as each day. If you're an option writer, you collect it daily. The risk, of course, there is when you're wrong, you're spectacularly wrong.
We just had a trader on who went through that very thing. That episode, I believe, hits tomorrow. Anyway, it's coming up. But we actually need to take a quick break here. We've got small cap fever on the other side, and the cure. That would be a rip-roaring discussion about our old pal, the Russell 2000. And it is VIX galore when we break out the scales on today's Who Wore It Better Volatility Edition. Coming up. We are back in this episode brought to you by the number 2000, which is a number of constituents in the Russell 2000. How small is small? We're talking a market cap of maybe 250 million all the way up to $2 billion or thereabouts. But Steve, small caps have been a frustrating place to be for a few years. Lots of failed breakouts to the upside, just sideways chop. When is it their time to shine?
Their time to shine is, unfortunately, right now, is you need either one of two things. You need either a really robust economy, which really allows the smaller companies to thrive because they don't have the pricing power of some of the giants, or you need very low interest rates. Unfortunately, right now we have neither, although we have the prospect of interest rates.
We have a growing economy, but at a slower pace, and the interest rates, well, they're on hold.
Which is why small caps are, near the Russell 2000 is at relatively high levels. It's not bad, but I think that's why you've had a couple of false starts. The other thing, though, the plus side is when this turns, and I don't know when it is, and I don't know that it's right now. The total market cap of the Russell 2000 is
like
less
half an NVIDIA or something.
Something like yeah,
okay.
Yeah.
We'll
something
check
of that age.
That's
yeah,
a good opportunity to use
we
this
could check the
screen,
numbers, but it would fit neatly into Apple. Mm-hmm. And so what that means is if the flood of money goes into the Russell 2000, there's a lot of room to boost things. The other flip side, unfortunately, is I think private equities hurt the Russell 2000 because they've picked off a lot of the best small companies over the years.
Just give us.
Yes. Well, I wanted to ask one question.
Sure.
So I've asked this to people before, and I get kind of mixed results. Is it important that small caps lead? Is it so bad if they don't
Good
participate?
question.
I don't think this. I think you don't need small caps to lead. I mean, we've learned that lesson, for the last few years. I think you have to. I think you're in the right ballpark, because I do think it's important for other sectors and for other things, let's say more than 7 stocks or 10 stocks, 15 stocks, whatever it is, to be pushing the market higher. I do think you want a broad-based rally. The problem is we've gotten so top-heavy that it's hard for, let's say, even the other 493 companies in the S&P 500 to provide much of a lift. I put a report together a couple of weeks, last week or the week before, about how top-heavy the indices are. So you've got like 8 stocks make up, when I wrote it, was about a third of the S&P 500, about half of the NASDAQ 100. And then even when you got into the S&P 500 sectoral indices, many of them are totally top-heavy. Obviously, tech and communication services, which are the same stocks I mentioned, but something like energy is basically Chevron, Exxon, and everybody else. So you do want to see the market broaden out, but right now we're in such a situation where it's tough because the big guys so dominate.
Yeah, I mean, I write market statistics every day, and I keep track, and I see, okay, industrials, another record high today. Staples is making another record high. Communication services, industrials, financials, all of those, do you think are too top heavy? Like maybe even financials with JP Morgan? How do you see that shaking out?
The only one that's not top heavy is industrials. Industrials is like sort of the platonic ideal of an index. I think it's sort of nothing has more.
Guys, more industrials, please.
Yeah, more. I think that no one has, I think, more than a 5% weighting down to like a 1% weighting, which is great. The XLF, the financial one, is actually a weird one because JP Morgan is somewhere only in the top. It's not the top of the index. It's
Berkshire.
It's Berkshire.
Yeah, right. It's
Visa. It's MasterCard, and it's JP Morgan. So I think JP Morgan may be second. But then what you end up with is roughly, I forget what the numbers off the top of my head. Call it 40% of that index is those 4 stocks, and 3 of them aren't even banks. Mm-hmm. So this is where it gets a little tricky. On the other hand, if I'm buying banks, I do want to see all the banks participate. I would like to make sure that like KRE is, which is not specifically a sector,
But it's a regional, so it's slightly regional. Maybe mid cap and some smaller banks.
But so I'd like to see them participating along with it, and also I'll tend to look at BKX rather than XLF sometimes because it's more bank centric. But yeah.
So bringing this back to just like an earlier investor and the big guys, the Mag 7 or the big mega cap indexes, is it important for a young investor to own any small caps or at least the Russell 2000 just for diversification purposes? Or, for someone who's not really trading stock, someone who's just ETFing it up, like, can you live without the Russell 2000?
I don't think so. I think you should have. I think you should have exposure to all the sectors. I'm not saying that just because I know they're a sponsor. I do think it's important. I do think it's important to have some allocation across a wide range of assets because you don't know what the next big thing is. It might be small caps. It might be gold. Younger investors, certainly prefer crypto to gold. But actually, gold is also flirting with all-time highs, which is not to say I'm a gold bug. I'm not saying but the point being, you don't know what's going to win, and so it is useful to have somewhat of a diversification. It's yes, in 2020 hindsight, had everybody just put all their money into NVIDIA, closed their eyes, and woken up 2 or 3 years later, sure, that would have been the best thing to do. In reality, life doesn't usually work that way, and so for a younger investor, where your time horizon, Sydney, is probably 40 years, give or take. I think it makes more sense to sort of to have some diversification. Stocks and bonds. Don't forget bonds. They provide a little bit of ballast to a portfolio. Don't forget dividend stocks because they provide some ballast.
All right, we got to get to today's Who Wore It Better, and we are going to put your options expertise to the test. We broke down the VIX earlier, expectations for S&P volatility over the next 30 days, but we also have the VIX's first derivative, the VVIX, or the VIX of the VIX. Don't let your head spin. We've also got the Russell 2000 VIX. We've got gold and oil VIX. Over in Bondland, we have the MOVE Index, just talking about bonds, and not to be left out, we also have implied correlation. And I know it's not necessarily proper to introduce all of these outliers here at this late stage in the episode, but I'm trying to be thorough here. I want to know which calculation deriving from options data is painting the best picture of the markets right now.
Implied correlation.
Yes.
I know that's all right. So Sydnee's like giving me the
No, I'm still stuck on the VVIX, honestly.
The VIX of the VIX?
Yeah, the VIX of the VIX.
VIX of the VIX. I don't love to go into that because that's like really down the
You got
rabbit
2
hole.
minutes.
Right, because VIX is a derivative of the S&P 500, and then VVIX is so it's a second order
fourth or-
derivative. Yeah, we'll get away from that. Correlation to me has been very helpful. I've been looking at the COR 1M index from the SIBO. It's a little bit of a wonky one. It's sort of the volatility correlation of the 50 biggest stocks in the S&P 500. But that was at record low levels just before we kind of had that little weird meltdown
On August 5th.
On August 5th. And it was starting to point to it. And what was interesting to me, and I put out a piece around that, was going down and VIX sort of stopped going down. And so remember what I said earlier about it being a proxy for institutional hedging. It was telling me that people were still buying hedges even as the correlation.
It was a divergence, basically.
It was. The reason for that is, think about an index. Let's say you have 2 stocks in an index. If they correlate real well, the index does this. If they correlate very poorly, they do this, meaning the index stays roughly the same, and so you get the correlation right now is very key. It was very low when it was basically 15 stock, 7 stocks and everybody else. It's come up a bit, but it was interesting that the correlation started to plunge again. So I've been watching that closely.
Yeah, it's really important to note that sector rotation, kind of the hallmark of bull markets, it disguises volatility under the surface because you have some sectors that are doing well, some that are bad, and it kind of evens out, and you don't see that much volatility at the index level.
We're saying index a lot, and I
Yes.
have a dumb question
I
for
think
you.
I got an idea.
Is it the plural indices or indexes? And I want the words to pop up behind me with the different spellings too,
You got it.
I'm not an editor.
This is an editorial decision. Sid.
I think they both
Where's
work.
Miles?
I think you need your editor in chief for that one, or a grammarian. Let's put it this way. When I write, I can get sloppy and use both of them, and the Microsoft Word editor doesn't correct me either way. So
Well, S&P, I've noticed, which does both the S&P 500 and the Dow, they'll use indices. But Dow Jones itself, they used to use indexes. They don't seem to do that anymore. But the FTSE will sometimes use indexes, and these are the different providers. So I think it's kind of a toss-up.
Well, and NVIDIA or NVIDIA? There it is. I know the answer, but I want to hear
okay,
Steve say it.
I say NVIDIA, but again, I don't know. I'll admit that that's just my sloppy pronunciation.
I think it's NVIDIA.
I think it's NVIDIA. All right. I want to say something. So you were just so well respected in this industry. With 30 seconds left, I want you to just tell us something that you wish you knew when you kind of started out learning
Got a
about
minute.
markets.
I guess the thing that I wish I'd known was, I would say personally the thing I sort of almost regret the most in my career is because of my role when we were market making was I was always the guy who had to look out for what could go wrong. We had a really good model. We were picking up a lot of pennies on the railroad tracks, to use your analogy, and my job was to make sure that we didn't get hit by the train. And so there are definitely times where I wish I could have been less skeptical because I've been professionally, I've had a great career being the skeptic, which kept us from losing a lot of money and kept us from disasters. But that would be kind of the thing is when you're young, take the risks.
Right. It sounds like an excellent place to leave it right there. We are winding things down here at Stocks in Translation. Be sure to check out our other episodes of the show on Yahoo Finance site, as well as the mobile app. Also, we are on all your favorite podcast platforms, YouTube, Apple, Spotify, iHeart, Podtail, Pod, Paradise, and more. Thank you for watching. Thank you for being here.
Thank you.